Okay, N. Jayakumar is with us, Group CEO and Managing Director at Prime Securities. Jake's great to have you with us here. Good morning. You have a plan. So we have, run us through what the plan is with regards to India, Jakes, and how should we deal with this? Go on.
Well, I wouldn't say it's my plan. I just think just taking off from the formula that's been handed over to the world as a whole. First of all, I wanted to split this up into saying, if you look at the way this has been presented, the Trump administration has talked about 10% for everyone and an incremental for each country, which is really a formula that divides the trade deficit that the Americans run vis-a-vis each country divided by the total exports from that country into America. So in India's case, it's about 42 billion on 80 billion, which means 42 billion of our trade surplus, which is their trade deficit, divided by 80 billion of their imports. Works out about 52%. So we've been handed out a 26% additional tariff. Now it's kind of a moot point, but if you really look at it, almost 10 to 12 billion of that is the Apple exports out of India. But let's leave that out for the moment. India, in a real sense, is not contributing materially to large numbers. The real problem of India seems to be its inability or unwillingness to allow access to markets in India freely, the non-tariff barriers, as they call. So there's an addressing of the non-tariff barriers that need to happen, which is to actually show access to American goods and services into various parts of India. So they've done a bit in terms of Google, etc. recently as a preamble to the negotiations going on. But in hard numbers, if you look at it, 10% is something that we're going to be handed over immediately, or in any case, because that's a global number. So if you take double of that, that's 20%. So 20% of our 80. So we are able to run a 16 billion trade deficit without a problem, trade surplus, compared to 41 billion, which is currently the case. So we need to find a solution to buy 25 billion of American products. We've already committed an incremental 10 billion for oil. That could easily go up to maybe even 15 or 20. And maybe a few other items that can take care of this 25 billion. So essentially the idea is kill this trade deficit number or the trade surplus number from our perspective by buying out 25 billion of American products. Oil we are buying from all over the world, including places like whether it's Venezuela or Iran or Russia or wherever. If we can adjust the basket to take care of close to, I would say, 15 to 20 billion of the oil and oil-related stuff, another 5 billion, and give some noticeable, visible market access. My own assessment is we kill not just the trade deficit issue, which means we go back to the 10% number that's applicable for the rest of the world, but more importantly, give Trump, which is what he's looking at. This morning's interview, he's already said that 50 countries have reached out to him. So really speaking, they're looking to be able to announce wins and some material benefit as a result of the 10%. Now, as you see today, all the other numbers have turned out to be a red herring, and people are now focused on eliminating the incremental over 10%. So the world at large, almost nobody other than China has complained. The EU threatened retaliatory steps, haven't done so. Japan kind of demurred but didn't say anything. Most of the smaller countries have accepted. India hasn't spoken a word. So I suspect what's going to happen is the win for America will be the 10%. The problem really is at the end of the day with China. We'll have to see what Japan, even Taiwan this morning has agreed. Smaller countries like Vietnam have agreed. So if you really look at it, behind all the bluster and the sort of screaming and shouting, I think it is the number of 10%, which is the win for America. And if that can be positioned in that manner, I think they're going to take the win and move on. I don't even think they expected to get tariffs beyond that without hurting demand.
You're saying, Jakes, that tariffs eventually will be negotiated down to that baseline 10%?
For almost all countries is what I believe.
Except maybe China, yeah.
Except maybe
because
China.
That's a $500 billion deficit. It's a much larger problem. They've announced retaliatory tariffs, and obviously it doesn't look good, PR-wise, right, to kind of sort of try to... So it becomes that... and the crazy thing is, if they're on that day, that Wednesday last week, they'd announced 10% tariffs, markets actually, I think, would have rallied. Maybe even 15% markets would have heaved a sigh of relief and rallied. But this is, of course, much bigger. I take your point. You're saying you can buy more of American goods, wipe this slate clean in terms of this deficit that US has with India. It's not much. We anyway buy about $80 billion worth of oil. So you might as well buy it from them, maybe if it's a little more expensive. The issue seems to be this: they seem to be suggesting that you need to this market access, etc., which is much harder to do. Non-tariff stuff, it's ingrained, right? It's not you cannot do that quickly. You can lower tariffs, you can cut tariffs, you can buy more from the US, but they are looking for this, which may take lots of time, and it's a problem not just for India but for the rest of the world as well. Quick answer, Jason. We want to get a quick market view as well. Go on.
No, I think the important thing is, other than, as I said, this market access thing, which is intangible for now, the numbers around which the tariff was built, that's to my mind easily, well, I say easily, I think it's immediately addressable. But the more important thing is they also talk about sectoral tariffs. So there are 3-4 sectors, whether it's steel, whether it's steel and aluminium, what they do in terms of branded items on the pharmaceutical side, I think they will leave out generics. So there may be certain sectoral numbers, which is outside the scope of this 25 or 10 or whatever the numbers are. So the auto number at 25, I think, will remain. There may be 1 or 2 more numbers coming out on sectoral. So I think there is a solution to this. But to arrive at this, he had to raise the bluster, raise the ante, as it were. Having said that, on the market access side, frankly, I don't think anybody has an easy solution. This will have to be, in some sense, smoke and mirrors, some sense, real access, but it'll take a while. And I think the problem will remain to be China, because China doesn't want to bow down. And on day one, had they indicated 10 for all and stopped there, the same hue and outcry would have happened as to bring down the 10 to 2 or 3 or 5%. So I think this, in a sense, the stakes had to be raised. Of course, there are enough and more, markets and different markets that have gone into complete tailspin. And if you look at it, we are still 2-3 days away from the 9th, and they've already talked about 50 countries reaching out to them. So my own feeling is, even from a Trump administration perspective, they can't keep this as a prolonged 2-quarter, 3-quarter kind of thing. This has to be done, at best in a few weeks.
Okay. So now let's talk about what investors need to be doing now, Jake's morning. While this plays out, the thing is, financial markets are dealing with this uncertainty, and we don't know eventually what number they boil down to. This meltdown is what's bothering investors, right? And I don't know if India can remain unscathed. We will start about 800, 900 points lower. So we're going to go back to the base of, pretty much the base of the range that we were at, until the March rally hit us. What should investors do? Should they just basically wait it out for the next couple of days till it settles? Should they still be buying every day? What would you tell people to do?
Well, for starters, if it's retail individual, I think please don't stop the SIPs, because I think that is the worst thing you can do. Having been, participating in SIPs over the last several years, you have this sharp dip and you're actually walking away from the markets at this point in time. I think it's impossible to say when markets will bottom out. You could take some sort of solace from the fact that Indian markets may have fallen, or maybe falling less than the other markets, which are far more export and numbers sensitive vis-a-vis their trade with the US. And clearly, if you look at it, whether it's markets like Japan, China, whether it's the EU, etc., maybe their sensitivity to American trade is far higher. I think the way I would look at it is, there are 1 or 2 sectors that are affected in India, which I think will come out unscathed. There are enough and more statements that have come out from Delhi, which indicates that they're doing what it takes to support. But I think one of the things that we will get to see is that this entire Make in India program, which is spurring manufacturing domestically, and if it's for American corporations, and actually, in a sense, paradoxically, increasing the trade deficit, I mean, we'll have to look at something that allows, more goods to come in. But from an investor perspective, I think some of these sharp drops may well, in retrospect, turn out to be good buying opportunities. I still think this 21,900, 2,200 could act as a very strong base, being equivalent to the last time's thing. What happens today, tomorrow, I think it's impossible for anybody to predict. And were I even to try and start doing any of this, it would be stupid. But what I can definitely say is that we could, maybe 2 weeks from today even, but certainly 2 quarters from today, look back and say that is a great opportunity to buy.
I think Jake's fantastic. 10 minutes, punchy and smart take. Really appreciate your time here, Jakes. And I hope officials in sort of Delhi are watching, listening. And as you said, I mean, they've, of course, indicated that they are, of course, in discussions and maybe even in advanced discussions, proposals, etc., with regards to how to mitigate some of these tariffs, etc., which have been announced. Thank you very much for joining us here on CNBC TV 18.